Okay, so this question is on some further substantive testing and some good balances for us to make and use as templates for when we get our own questions. Some basic introduction. 1st of July, Lantern manufacture glassware. Year end is the 31st of March. This is their revenue, PBT, and what are the audit matters. So they pay a bonus to their staff if they achieve a specified sales target. The FD is concerned that the sales staff have recorded fictitious sales in order to increase their bonuses. So we know we're going to be doing some work around that. Um, so, um, so generally, all sales are made on credit. Sales staff are responsible for performing credit checks. You notice during your test these credit checks are rarely performed. The value of receivables here are pretty old, 780,000. Typically, standard credit terms are 30 days. So here are the questions: your responsibility towards fraud and error. Now, what's interesting in this question is that there is actually the potential for fraud. Sometimes you just get this question in general. And so I do a bit of a mix where you just talk about it in general, but where you do have particular cases, you can be a bit more direct with a few more questions that are slightly more personalized. And in terms of your planning, your sense of awareness, if you like, your professional skepticism is higher because you already know that there is potential fraud. I think good marks can always be earned by just defining what the differences are. I mean, fraud is intentional, isn't it? Intentional act. So this is if the question was just asked, because like I said, they tend to just ask these 5 markers, just give us an understanding knowledge question. Intentional act to misappropriate or misrepresent by people working in cahoot to override controls and take advantage to hide their tracks. So it is the duty of management to implement a culture and internal controls that will prevent fraud. So it's not our duty, it's the duty. An error is really just occurs due to a lack of knowledge by mistake, as in unintentional. These are two different things. So the word error was in that question, so they did still want you to talk about what error was. They said, what's the difference? So it is our role as auditors to design procedures and tests and via AEIOU, analytical inquiry, that will identify material misstatement either due to fraud or error. So um, that's really the point. When you have this kind of unique scenario where they do mention it, you want to highlight that as part of our planning, we will let all our auditors know, professional skepticism, be aware, inquire of management, um, and carry out further procedures where we believe that where there's some indication that there is fraud. So we know, so we make it even more material, as in we make it a balance that we want to spend more time in. Apply professional skepticism when performing the audit. Of course, again, yeah, sorry, this is just a repeat of that. Okay, I don't know if I've done this in order, but there are 3 issues: receivables, revenue, and the sales related bonuses. So in terms of receivables, when it comes to valuation, um, a good way to start, again, and I think the mark scheme is brilliant. You want to keep the mark scheme. I've done my answers, and I'll of course marry those to the mark scheme in terms of having a template in your head. You always want to first obtain your list of receivables at the year end. So let's actually get what's on the accounts. What we're here likely to see with receivables is a question of overstatement, isn't it? Overstatement. So it's not really about completeness, it's the fact that there's too much on there. So what we want to do is analyze. We always want to analyze those key balances, um, not just as a general, but really analyzing individual balances to see what's going on. And also just general analysis via 30-day, 60-day, 90-day analysis. And so we can capture those balances in the sort of 60, 90, 120-day area. That's kind of the point. Um, then, of course, in terms of valuation, we are, of course, assessing post year end date cash, um, assessing outstanding receipts as at the year end. Sorry, as at when you are doing your work and investigating correspondence to understand, reviewing allowances. I mean, I've made mine up. It doesn't really matter. I'm just trying to assess the reasonableness of the allowances and whether the allowances are enough, as in the provisions. So it says and the process and reasonableness of these. So inquire of management, how are you assessing these provisions? And of course, correspondence with lawyers, um, and correspondence with outstanding debtors as to the potential for payment. So I suppose another, yeah, so that's kind of because it's an asset, so we're really trying to understand whether or not, look at the current value. Revenue. So what we are assessing again here is potential for overstatement. In terms of, I suppose, existence, what you're looking at is, did it even happen? So look through the year and pick certain, if you like, figures from the sales ledger that, of course, have fed into the accounts, and trace them back to the goods dispatch note and the sales order to confirm existence. So you can test existence that way. That's one thing. There is also the issue of cutoff testing. So what we're really trying to do is to ensure that only goods dispatched, well, basically goods dispatched post year end are not in the current year, because it's very possible to raise a sales invoice prior to the year end, but the goods are dispatched after the year end. We don't want that. We want to make sure that goods dispatched post year end are not in the current year. So basically, only goods dispatched pre-year should be recognized in revenue. Then you can assess a sample of invoices for accuracy as well. There are the credit note. Credit notes are a big one. Conclude that. So credit notes post year end need to be reversed. Well, credit notes post year end to do with sales pre year end, right? Because they aren't actually sales, they were returned. I think you can do a further test along that for window dressing, just to be sure that if you see a high volume of credit notes post year end, it means that a lot of the sales made pre year end are flawed or aren't genuine. I think I kind of mix. I mean, again, when you're doing this, of course, we separate out, because we have a unique scenario here, where we have this particular problem, don't we, of inflated revenue. Um, so I've actually asked to obtain external to the sales system the full list of sales staff and their associated contracts, highlighting their associated bonuses, if you like, because I'm focusing on the sales bonus business here. Agree the process of calculating the bonuses. Consider a sample of sales employees and their relevant associated invoices, recalculate bonuses, and agree that to the bonus income. Yes, and I said here that apply segregated sampling, picking an increased number of invoices at the year end for the sales staff. So we want to almost test existence in particular to these sales staff, don't we? Because we're basically walking backwards. So what you saw me do earlier on was just a general review of revenue, and then you can then hone in a little more on the actual problem, right? So you are doing general work, but you're also doing your focused work. So as this is an assessment of existence, agree figures again to the sales ledger, to the goods dispatched and respective sales orders. So we want to know that, are these sales genuine for these, in these months where the revenue is particularly high. And then, of course, again, review up-to-date cash, as it has been 3 months post the year end. The provision one was quite nice. They rejected your full provision. They've put in a provision of 390, which means the disagreement is on 390. Assess for materiality. Take that as a percentage of profit before tax. It's 4.2. So as far as we're concerned, remember PBT, we're going 5 to 10%. It is less than 5%. So therefore, it's not even material. It's not even material. So therefore, the accounts are fine. The accounts are unmodified. I've put here the management letter should highlight the need for this adjusting journal still, and the written representation where management state why they have not put in the adjustment. Oh, great stuff. So please, of course, still review the mark scheme. That's important because, of course, we want to get our answers to look like theirs. On the day, it won't be, but you're trying to pick up on that to get your answers to look like the mark scheme as much as possible. Okay.